Hi, I'm Steven Van Metre, and welcome to our Wednesday night premiere. We take 15 minutes every Monday and Wednesday night to try to make sense of a market that still doesn't make much sense. And if you thought it made sense, wait till you see what we're going to look at today. And it makes absolutely no sense. We had bad news from the economic data coming out of China, which is interesting because their data now shows retail sales are as bad as they were going back to 2003. And for an economy who's well known for making up numbers, well, they couldn't even beat their own estimates. I mean, it was just ugly. Tacking onto that, we had poor U.S. economic data. We had oil inventory building. Now, you would think that people would look at this and be like, let's see, economic data is getting worse. Oil inventories are building. It's probably not a good time to buy stocks. And you'd be wrong. They did buy stocks. And the smart money has been buying bonds. Yeah, it's pretty crazy what's going on out there. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell security, financial product, instrument, or to participate in particular trading strategies. This video was prepared by Steven Van Metre on purpose, capacity, and opinions expressed video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. Now, there's only one way to look at this. It's to show you the charts. All right, so remember, the markets make the news. The news does not make the markets. That is very important. All right, so let's look at the S&P 500, and you can see we've got this band of support. I know I called it resistance on Monday, and that was my mistake. This is now support. And what support is it's a price level. It's arbitrary. It's where the market decides it's going to be, of a place where people want to buy, are happy buying, and when prices return to that level, they want to buy more. So it's no different than, say, going down to your local store, you see something you like, and you buy it. You come back the next week, the price is up, so maybe you buy a little bit. You come back the week after, the price is down, you buy more. The price stays down, you buy more. That's the whole idea here. So it becomes a level of support, and support being this is a price level where people want to buy, not sell. Now, if we would have seen sellers come out at this level, or people that previously bought start to sell, it would be different. But let's go back and look. Now let's zoom in on the daily chart, and you can see it hit support in early trading. Pretty much took off from there. This move here was on the notion that we are not going to tariff the European Union for auto imports. There's a reason why, and that is because mostly German auto manufacturers understand very clearly, you want to do business in the United States, go open a factory there, and they'll leave you alone. And they've done it, and they're going to do more of it. They get it. So don't expect much from that. Why that got the market excited, I have no idea. But let's look at a 10-day chart on the S&P 500, and you can see it got down in here to this support level, and buyers came in and came out, bought again, and there you go. Now, from a second technical perspective, so the first technical perspective is support held. And when support holds, support could care less what the economic news is. It simply says, hey, no one wanted to sell, sweet, let's buy. And let's buy more. Now let's go look at the ETF, the S&P 500 ETF, and we get this nice, pretty clear picture that it crossed the 50-day moving average in green. Remember, rallies start at the cross, so you watch the first one, and then you look for the next one. And the next one you want to see sit right here, and then bounce off of that and go. But this broke through, and now it's coming up on the underside, the belly of the 50-day moving average, and at least as of today, it was rejected. So we know for now that buyers did come in. There wasn't a ton of volume, but they still came in because prices, bottom line is, they held support. It does, again, nothing else matters, period, when it comes to the market other than holding support price levels through either support or resistance. Now let's look at 10-year Treasury yields, because something very, very interesting is happening in the Treasury market. And once again, you would think that interest rates should be rising. In fact, if we were to overlay the S&P 500, and we'll do that here, and here's the S&P 500, what this chart, at least the 6-month chart, is telling us that 10-year Treasury should be near 3. If we go to a 1-year chart, it's telling us they should be at 3.1%. If we go to a 2-year chart, they're telling us they should be between 3 and 3.1%. But look what's happening to the Treasury market yields actually went down last night because the rest of the world is not going crazy over stocks like American investors are. And let me show you what's going on with the rest of the world. And here you go. So here is the major foreign holders of U.S. Treasury securities as put out by the Department of the Treasury. And let's just go back to December. $3.949 trillion worth of treasuries. It increased about, say, 31 billion between December and January. Increased another 45 billion January to February. And here, February to March, we get a very nice increase of, say, another, we'll just say $45 billion worth of bonds. So you continue to see that foreign investors, whether it be central banks, investors, insurance companies, corporations, banks, doesn't matter, they're buying bonds. Again, keep this in mind. Everybody else in the world is buying bonds except U.S. investors. For U.S. investors are just so in love with stocks, they can't see anything else. And the rest of the world is watching the global economy slow down, and they're buying bonds, which is exactly what you should do. So now you can see that the major foreign holders of treasuries are indeed buying bonds. And let's look at the 10-year treasury, which is right back at its March lows. It actually came and pretty much tagged the March lows in overnight trading, bounced up today because, again, as interest rates fall, financial conditions tighten. I know you think the opposite. Well, man, if interest rates are low, it means you can borrow. Well, think about this. During the last recession, interest rates were in the toilet, and not many people could get, hey, I got credit and I got money. Yeah, it doesn't mean you get a loan. And so financial conditions are clearly tightening. They're as tight as they were back in March. And back in March, what happened is we needed Federal Reserve, we needed Steve Mnuchin, we needed everybody talking the market up from the December lows, and the financial conditions still tighten. From a longer term perspective, we are now at a cusp where we're looking at a major move down in yields. It's probably going to get down here into this 2.3 lower 2.3% range. But as soon as it breaks below this, we could even extend this down just a little bit if we wanted, somewhere around 2.3. If it breaks there, this thing is headed all the way back down to 1.9%. This is a topping pattern. I've said it pretty much from here forward. But what is unique about this is you've got all these people that are from all the way back in November of 2016, November 2016, that are short the bond market. And the only way they can get out of those shorts when they get squeezed. And I can tell you, as of right now, anyone that was shorting the bond market starting late November 2016 has lost money because they have to pay interest on all the monthly dividends that are due. All of these people, maybe some of these, they're either in a negative equity position or their profit is thin. So as yields continue to fall, you get squeezed out. They have to become buyers of bonds, so they have to go out. To exit a short position, you become a buyer. Whether you directly or indirectly become a buyer, doesn't matter. You become a buyer. And when there's not much liquidity or money sloshing around the system, where does that buying come from? Well, it comes from selling stocks. And that is why the treasury yields and the stock market have a symbiotic relationship. When interest rates go down, stock prices go down with them. When interest rates go up, stock prices go up. So this is telling us financial conditions are tightening. We're back at a cusp where this could break lower. We might see another move like this where it came down here and is going to bounce up around in here. And before it goes down, I don't know, maybe this will do it. But bottom line is we're seeing banks and foreigners buying monster amount of treasury bonds every month, despite whatever you're hearing in the news. All right, so let's go and take a look at some other charts. From a trading volume perspective, looking at the large S&P 500 ETF, not a lot of volume here based on this recent price move up to the 50-day moving average. Let's take a look at the 7 to 10 year treasury bonds. We're seeing some decent volume here. Nothing spectacular, but look, prices getting closer to breaking out, and we can see the same chart where there's this big gap getting up here where prices are headed next, and it gets over this 109 level, and there's really nothing keeping interest rates and bond prices from seeing their all-time high. And for a lot of people who are focused on the stock market, if you want to look at where the 1-year returns have been, it's been here in the bond market, looking at the last 12 months, looking at the S&P 500 last 12 months. The return is in the bond market, folks. That's how you know what the truth is. It's the bond market. Bond market always speaks the truth. There are more bonds traded than anything else. There are far more bonds than stocks in this world, and they're telling you the truth. Looking at TLT, the 20-plus Treasury bond market, it too is on the cusp of breaking up into its next resistance zone. So it's definitely in a bull market trend as well. On to, let's look at emerging markets first. EM came back up and is sitting right here at its resistance level. It kind of dipped below and is fighting to get up into resistance, because if it cannot break back through resistance, if support here, this purple line has now become resistance, what that means is prices are headed lower back down to its November and December lows. If we get a triple bottom here, that would be very, very bullish. Now, from a long-term perspective, you can see this channel right here is consistent. It tags this all the time. And then what it does is it takes off. So if we get a double bottom like we had here, boom, boom, it came up. This looks very similar, comes back down, tags and goes. Then you notice there's going to be a nice run here. And this is going to match a run in the miners, the gold and silver miners. So we're going to look at that next. If this does not hold right in here, then we're going to get a deeper sell-off, maybe back somewhere down into this, $30 to $34 price range. Will we get a big sell-off, like we saw in 08 and 09? Possibly. Hard to say where the market's going to go next. We do know that when all these people that are short volatility get yanked, there's going to be some heavy selling. How much of it will affect EM, I don't know. But let's look at gold. Now gold, we'll go to a 1-year chart. It couldn't sell off here, so it came up, hit resistance at 1,300, selling. And again, this should come the more I look at this chart and the more I look at EEM and I look at the silver miners, you would see that this thing's headed back down to 1,200 pretty quick. Let's look at the large gold miners. They're trying to find buyers here, just not really finding a whole lot. Again, this should come all the way back, I'm thinking now into this low $18 price range. Because let's look at silver. Silver is trying to find support here. Here's this is a pretty big short-term area of support, because we got price support here, and here, and kind of here. Now, from a long-term perspective on the silver mining stocks, if it fails to hold support here, you're going to have a big unwinding of all these people that bought in here, because there's nothing to hold this up until you get down into, say, the mid $18 price range. I mean, you start at 20 is where the next level of support begins, but the big price support is right here, right around $18 and 81 cents. Yeah, 1881, maybe even lower. And I want to point out on this chart, I did not mean to click that, but let's go to the weeklies. Look what happens when this thing takes these big sell-offs, these multi-year declines, it goes straight up. Multi-year decline. So the next move is going to be higher. And the fact that this thing is going lower, this is a back the truck up opportunity in the mining space. And I've said before, it's going to be difficult to buy these silver miners. But if these silver miners get down into here and the gold doesn't fall, which it will, because you can see it always eventually does. The gold miners trade, you can see somewhere in 355, 200 million shares a week. Silver miners are trading at, in the peaks 1.7 million. It's really just not enough for us to get in. But this is where I would, if this went down and the gold miners didn't, this is where I get on the phone and start seeing what TD Ameritrade can do in terms of getting us in without having to pay a big asking spread. So where we come to buy and they say, well, we'll let you buy all that, but it's gonna cost you quite a bit more than you'd want to pay. That is the benefit of largely traded exchange traded funds is, say the price is at 20 and you come into a buy offer, you can probably buy it at $20 and a penny, penny over ask. If it's thinly traded, such as the silver miners, and I come in and say, I want to buy 5 million shares a day, I'm going to pay a lot over ask. So my choices become buy such a tiny amount every day, wondering how I'm going to sell it, or I hope the larger, more deeply traded mining stocks fall, which they generally do. I mean, look, if I overlay real quick gold and silver, you'll see GDX. I mean, you can see there they are. The only way that they're not in sync is right here, right now. So that means the gold mine stocks need to come down to somewhere, what did I say, in the 18, low 18, maybe $17 price range. So we know the gold miners are off, and there's not much. Of course, it would help if I actually showed you the chart here. You can see the longer trend view. They're very symbiotic. They run together, but when you zoom in a little bit, you can see here we need to be down in the $17 price range for these two to line up. So either silver miners are too cheap, possibly, or gold miners are too expensive. Like to be in the gold miners just so we can get out, but if silver sells down and gold holds, I will call TD Ameritrade and figure out some way to get us in there. It may take me several weeks, but we'll figure out a way if that's where the opportunity knocks. So I'm Steve Van Metre. We'll be back with you Friday. Thanks for watching. Bye now.